Okay, good morning. We're going to go ahead and get things kicked off. A few opening comments. First, on behalf of National Bank of Arizona and Montage Partners, welcome to the event. Thank you for being here. I'm Jordan Tate. I'm a partner at Montage Partners. I'll be serving as moderator for our two panels today. Many of you may know us, some of you probably don't. So for those who don't, Montage Partners is an Arizona-based private equity firm founded in 2004, managing $70 million of capital and investing in established, successful companies across North America with 1 to 5 million of EBITDA. At the end of the day, we exist to provide liquidity to founders and growth capital to management teams. And that ties in with what we're going to be talking about today, which is hopefully an educational event with real take-home value for those who are joining who may be exploring a sale of their company and may want to hear some tips on what's gone well for others who've been down that road and what things to potentially avoid. So today's webinar, in terms of format, is going to consist of two panel discussions. The first panel consists of 5 transaction experts. We'll be discussing topics including legal structure, tax considerations, how to prepare for financial diligence. And then the second panel consists of 4 founders who've successfully built companies and then successfully navigated their companies through a liquidity event. And they'll be sharing their stories as well as some advice on what to look out for. During either of the panels, feel free to submit questions at any time via the questions box on your screen. And we've carved out time at the end of each of the 2 panels to tackle those questions. So before we dive into introductions for our transaction panel, we hope that there's some real take-home value, and the discussion with the transaction experts and the founders gives everyone on the call some things to think about that results in, for those who are going to go down a sale process, entering that process with more confidence and better prepared than you might have been otherwise. So with that, let's bring up our 5 panelists for the transaction expert discussion. And I'll provide a little bit of background on each before we dig into the topics. Hello, everyone. So I'll give a brief intro on everyone, and then we'll dive into questions. Before doing intros, though, one, I'd like to say thank you to all of you for joining. It may be easy to take for granted the expertise that you have since you live it on a day-to-day basis, but for somebody who's never been through an M&A transaction, a lot of things are going to hit them that are new. There's going to be a lot of terminology they may have never heard before, and they may not be aware of things to look out for. So appreciate you sharing your expertise. And I know for each of you, you've been through transactions that involve a variety of companies in different industries, a variety of different types of buyers, a variety of different transaction structures, and those experiences number in the dozens, or for some of you in the hundreds, and there's a lot of value in that experience that I think we can share with everyone today. So with that, Andy Western. So Andy is a partner at the law firm Osborne Maladon and one of the most active M&A and securities attorneys in Arizona. We know Andy very well at Montage Partners. We've worked with Andy and his team on at least 9 transactions as a buyer, as a seller, and in connection with various corporate matters at the companies that we're an investor in today. Outside of his day job, Andy's very actively involved in the Phoenix community, including being chair of the 2021 Fiesta Bowl committee. Andy received his JD from UCLA Law School and practiced law in Southern California at Latham & Watkins before finding his way back home to Arizona to join Osborne Maladon in 2013. So Andy, welcome, and thanks for being here.
Thanks for having me.
Christina Roderick. So Christina is a principal and tax practice leader at the accounting firm REDW and leads the firm's Phoenix office. Christina has more than 20 years of experience in public accounting. Her practices focus on companies in the manufacturing, distribution, real estate, technology, and healthcare industries. and includes things like advice on transaction structuring, tax compliance, and advising on tax credits and incentives. Christina, thanks for being here and thanks for sharing your experience with us.
Good morning, all.
Okay, next, Jeff Servais. So Jeff is a principal at the accounting firm Clifton Larson Allen and is based in CLA's Dallas office, where Jeff leads the firm's transaction services group. For those who may not know what we mean by transaction services, we'll dive into that topic here in a few minutes. Jeff has over 15 years of public accounting experience, and his work primarily focuses on providing financial accounting due diligence, transaction structuring advice, with a focus on companies in the business services, manufacturing, and technology industries. Jeff, thanks for carving out the time. Appreciate you being here.
Thanks, appreciate you inviting me.
Okay, Mary Holman. Mary is Executive Vice President and Director of Private Banking at National Bank of Arizona, a co-sponsor of today's event. Mary has more than 35 years of banking experience and is a member of NBAZ's Executive Management Committee. As Executive Vice President, Mary is responsible for strategically growing NBAZ's private bank through new services and through credit solutions for high net worth clients. Mary, thanks for joining us, and thanks to NBAZ for co-hosting today's webinar.
Thank you, Jordan. Glad to be here.
And finally, JT Vandegrift. JT, welcome. JT is a principal and financial advisor at CapTrust. CapTrust is a Raleigh, North Carolina-based registered investment advisor, managing approximately $50 billion of assets. JT joined CapTrust through CapTrust's recent acquisition of Phoenix-based MRA Associates, which closed in January 2021. As a principal at CapTrust, JT provides portfolio management and financial planning advice to families, foundations, and institutions. And prior to CapTrust MRA, JT was an investment manager at BOK Financial, and prior to that at JP Morgan. JT, thanks for being here. Appreciate you sharing your expertise with everyone.
Absolutely, thank you.
Okay, well, let's dive into the discussion. And Andy, I'd like to start with you. So two of the most fundamental topics that need to be addressed in any transaction are purchase price and legal structure. But it's easy to gloss over legal structure. For those who haven't been through an M&A process before, when we talk about the term legal structure, what do we mean by structure?
Yeah, it's a good question. So when we talk about the legal structure, what we're really talking about is sort of the legal and also tax framework for your transaction. And it governs the mechanics of the transactions and the steps we will have to take, approvals we'll have to get. So if you think of it from a sports analogy perspective, it's almost like a defensive or offensive scheme, and then within that scheme you can run different plays. There's different tactics you can have, but it's sort of an overall framework.
Perfect, that's helpful. And realizing we have limited time, can you share some thoughts on just some of the more common legal structures that you see and maybe some of the basic implications that those would have for both a buyer and a seller?
Yeah, there's really three basic transaction structures that you'll see out there in 99% of the deals. It's an equity sale or a stock sale is one of them. An asset sale is the second, and then a merger is the third. An equity sale or a stock sale is exactly that. It's the owner of the business selling his or her shares of their corporation or membership interests of their LLC to the buyer entity. That's generally easier from a seller perspective because your company, the target company, remains in place. It's just you're changing out the owners. An asset sale is actually the target company picking and choosing which assets, which liabilities it's going to transfer to the buyer. So the selling entity remains in place after the deal. Sometimes a buyer prefers this if they don't want to buy the entire business. If they're just buying portions of the business, it's easier to carve those out in an asset structure. And then a merger is technically the selling entity, the company merging with and into another entity. It could be a subsidiary of the buyer. It functions more like a stock sale or an equity sale, but those are really your three basic structures.
That's a great primer, and we'll dive in a little deeper on tax implications here in a minute with Christina's thoughts. But Andy, another question. Our experience has been that founders of companies will involve legal counsel at very different times in the transaction, ranging from at the very start of a discussion, well before an LOI or letter of intent is documented, ranging to holding off until that letter of intent, which might be very detailed, has been documented and it's time to draft the definitive purchase agreement. When do you typically get involved in a transaction, and how would you advise those who are considering launching a sale process to think about when to get legal counsel involved?
Yeah, so my personal perspective is the earlier the better, and I think really the early interactions do not have to be a lot. It doesn't have to be a very expensive process early on. So what I always try to talk to sellers about is engage legal counsel early on, just to talk about the process and understand the overall process. Maybe talk a little bit about the due diligence process that you're going to go through, where a buyer is investigating your company and looking through your financials, looking through your contracts. Talk with a lawyer early on that has M&A experience, because they'll help you get organized and prepare for that, and that'll make that process run more smoothly. And then I think substantively, it really makes sense to get your legal counsel involved once you're getting into that letter of intent or term sheet stage, because generally there are going to be some terms in that letter of intent or term sheet that are going to have legal implications. It's going to be, the 3 transaction structures we talked about. There may be some other more legal type of terms that are really material to the transaction that often get baked into a letter of intent or a term sheet. And so I think it makes sense to have your legal counsel at least advising you at that point of the transaction, so you don't gloss over something that really turns out to be a material issue. And then obviously once the actual definitive documentation starts, that's really when your legal counsel is kicking into high gear.
Makes sense. And one of the things you mentioned there was there may be specific terms or things that get baked into a letter of intent that will show up later in the purchase agreement that would a founder would be well served to have legal counsel weigh in on during drafting the letter of intent. One of those that kind of sits outside of purchase price and legal structure, that's common to almost every transaction, but maybe a term that a founder may have never heard before, is the net working capital target, the concept of a net working capital target. Do you mind just giving a real quick explanation of what we mean by net working capital target and sort of what role that ends up playing in the actual purchase agreement?
Yeah, so a net working capital mechanism is the idea that on day one after the deal is done, the company will have a normalized amount of basically cash and current assets, or sometimes it's just current assets, so the business can operate on day one without a massive infusion of assets so the company can function. So typically what happens is a buyer and a seller will look at financials, whether it's trailing 12 months or some other time period, and they'll look at what is the typical or normal amount of working capital that the company has in its accounts at any given time. And you pick that target, and then basically at the closing, you just do a true-up process of, did the company have more working capital than the target number, or less working capital than the target number? And you do a post-closing true-up of, if the company had more working capital, the seller will get that difference in a payout. If the company had less, typically then there's maybe some kind of an escrow where the buyer can make up that difference from the escrow amount.
And fair to say that the spirit of the net working capital target is meant to be somewhat neutral to both parties, but it's something that if someone's not paying attention to it, it can be either accretive to a transaction or punitive. So it's an important concept, but fair to say that the spirit of that is not meant to be advantageous to either buyer or seller if it's structured properly.
That's correct. So that's really the process of how you get to that target number is what's the average or typical amount of working capital the target company has had over the last 12 months, 18 months, whatever the right time period is. And so that's what you're shooting for, is that normal amount of working capital, not too high, not too low.
Got it. And maybe one last topic is, this comes up, I think, fairly frequently. So if I'm the founder of a successful company and I've poured 20, 30 years of blood, sweat, and tears into building a successful business, I likely already have a legal counsel relationship, whether it's for estate planning matters on the personal side or whether it's for corporate matters at the company. As I start thinking about launching a sale process, or I'm entering into discussions with a prospective buyer, can you talk a little bit about your views on the pros and cons of using my longtime relationship versus hiring an M&A specialist to represent me in the transaction?
Yeah, so I think the first thing I'll say is, obviously trust is a big part of any relationship between a business owner and their advisors, legal and non-legal. So I don't want to discount the fact that a business owner may have a very strong relationship with kind of an existing counsel that doesn't have any mergers and acquisitions experience. And there is value to having that familiarity, to having that trusted relationship. But I think a key component of that is that trusted advisor knowing what they don't know and being honest about what they don't know. Often I've been brought in on transactions by a business owner's counsel that they've used for the last 10, 15, 20 years, because they know they don't know the mergers and acquisitions process. They don't know what the customary terms are, and they want their client to get the best deal they can. And that's really the value add that an M&A specialist would have in a transaction, is you can advise the client on what the process is and what to expect and how to be prepared for it. And you can then, as you're in that process, advise the client on what are customary terms, what are reasonable terms, where is kind of the middle ground going to be. And that really helps you as a business owner, as a seller, understand, am I agreeing to customary terms? Am I agreeing to non-customary terms? Because this is an area where most sellers don't have very much experience, so they're a little bit flying blind if they don't have an advisor that has that experience.
Yeah, that makes sense. I'd love to kind of hear your thoughts and pull you into the conversation, and ultimately would love to kind of circle back to the tax implications topic that Andy touched on briefly. But before we do that, I think it'd also be helpful to hear your thoughts on a similar version of the question I asked Andy, which is, when, as tax advisor, when do you typically get involved in a transaction process? And to the extent it's a different answer, when would you prefer to get involved in a transaction process?
Yeah, that's a great question. Thanks, Jordan. And so generally speaking, for our client base, we tend to be involved years before a transaction. And so we really feel it's important to work with our clients and understand what their exit plan looks like. And so, generally we'll have an annual meeting with them to talk about those types of items and really keep it on the forefront of, where are they heading in their business. And it's also very important for us to do that from a tax compliance standpoint, because it gives us the opportunity to talk to our clients as to why they should be filing in more than their resident state, for example, or why they should care about sales tax compliance, because those are things that generally come up through the due diligence process. And so if they're 3 to 5 years or even 1 to 3 years to exit, we say, let's clean house, let's make sure we're compliant, let's make sure we're doing everything we can from a tax position. The other thing that we do, and we find this very valuable to our clients, is if they think they're going to exit, really in the next 1 to 5 years, we will start modeling out what that might look like. If it's an asset sale, if it's a cash sale, and we'll say, okay, what do you think your value is worth today, and what do you need it to be to retire off of those proceeds, or to feel, secure on that sale, or feel that sale is a good transaction for you. And so generally when we model those things, we're looking at everything on an after-tax cash basis, and that really helps clients kind of start putting in their mindset as to what would a sale look like for me, or what would be a good transaction? And so we like to be very involved really years in advance. Similar to Andy, we know that's not the norm in the, working with tax advisors. And so we often get referred by other CPAs whose clients are in the middle of a transaction, who don't have the expertise working through, either diligence or structuring for sale. And so often we come in midway through and say, okay, let's either clean up the sales tax issues you have or income tax issues, or let's help in structuring and tax planning for this transaction that's already on the table.
Yep, so it sounds like the earlier the better in terms of planning forward for a transaction before anything has been discussed or documented. But to the extent that I'm in a position where, say, I've built a company and I haven't done that, but I want to make sure that I'm both compliant from a tax perspective, but also being efficient, it sounds like early in that transaction negotiation would be a good time for you to get involved if we haven't already discussed it prior to that. And that way you can help somebody kind of navigate within the legal structure to make sure they're optimizing from a tax perspective.
Correct. Yeah, absolutely.
So I realize this is probably a tough question because it's so deep. Given the time limits, it would be impossible to kind of touch on everything here. But for everyone's benefit, can you share just some initial thoughts on the tax implications of choice of legal structure in maybe some more common legal structures?
Sure. So, the flexibility of the structure really is going to help determine what kind of transaction occurs, if it's equity or stock, or at least what the tax implications are. And so for example, an LLC is generally going to be taxed as a partnership. And in that structure, a buyer can come in and kind of cherry pick which assets they want. They can structure things so that the buyer gets a step up in the value of those assets. The founder or the seller can roll equity, and so LLCs in general are very flexible. There doesn't need to be a qualified buyer of that LLC, and so often that's probably why LLCs are so popular, is you can recapitalize them very easily. You can issue more units. There's just so much flexibility in that legal structure. The next structure that's also very flexible is the C corporation. And so C corporation, generally, the only thing that we have to plan around is the double tax issue. And so because any asset sale would create a double tax situation, we have to consider what does that look like on an after-tax basis. And so that's, another structure that is very popular. And then, the last is kind of an S corporation, which could be an LLC or a C corp legally, but an S election allows for a special tax treatment. While that's a very popular structure for small business owners, it is something that is not always ideal when you're going to market to sell your company, because generally you're going to sell your company to someone who's not a qualified S corp shareholder. So if you're if you're bringing in foreign investment, or you're bringing in, private equity company, or someone who's going to structure as an LLC or a C corporation, an S corporation in general will need some sort of restructure to have the sale get completed.
Yep, and that makes sense. And that's because the S election requires all individual shareholders. So if the buyer is an entity, then they're disqualified from carrying on that S election.
That is correct.
Got it. And so one of these kind of terms that may be new to people embarking on a sale process is the concept of a purchase price allocation. Can you touch on what that means, what we mean by purchase price allocation, and when that would apply to a transaction?
Sure. So purchase price really purchase price allocation is really just that. It's the allocation of the purchase price proceeds as contemplated in the transaction. And so purchase price is a code section, 1060 code section with the IRS that basically says buyer and seller need to value the assets the same way. And so with the IRS and report it to the IRS the same way. So we can't have buyer reporting, nothing but inventory and depreciable assets, which give them huge tax write-offs, right away, and have seller reporting nothing but capital gain. The two parties truly have to come together and say what's fair market value for these assets and assign a purchase price to those class of assets. In the purchase price really drives tax treatment on sale, and so assuming we don't have a C corporation complete stock sale, just about every other sale transaction, whether it's asset or an equity purchase of an LLC, for example, is going to have some sort of purchase price allocation requirement. We're going to have to value what the assets are by classes because that determines tax treatment. And when I say tax treatment, I mean what is capital versus ordinary. And again, when we look at things at an after-tax basis, those characters of assets really matter.
And I imagine that's where it's helpful to have advice from a tax perspective, because is it true that each of those lines on the purchase price allocation may be taxed differently? And so how the purchase price is spread across those assets matters a great deal.
Yeah, that's correct, Jordan. And also, with that, it allows us to really advise clients on how to, structure that purchase price, but also understand what is considered purchase price. So, for example, often clients don't think that transaction costs that perhaps the seller's paying on their behalf or liabilities being assumed are purchase price. And in many structures, that's incorrect. Those are additional consideration that the founder is receiving. And so, again, the sooner we can be involved and kind of help model that math is very important.
Got it. Thanks, Christina. Before we loop Jeff in, maybe just any sort of general parting advice for founders who may be considering a sale in the coming months or the coming year as to things they should at least put on their radar to think about from a tax planning perspective?
Yeah, absolutely. Really, if you're 1 year out and you've not done an exercise on, what does an after-tax sale look like, and again, just using a kind of a hypothetical purchase price is really all you need to start modeling out. And what does the structure look like if it's asset versus sale? I think that kind of modeling is really important for anyone contemplating a transaction. And then really, similar to what Andy said, it's important to get someone involved soon, either within 12 months of transaction or definitely by the time you have an LOI in place, because you do need a clean house. So if you haven't been compliant with tax filings, whether it's sales or income tax, you need to do so. And often we find with our small business clients that they've made promises, for example, to their key management team, but they've not put any of those agreements in place to actually provide for, a tax efficient either transfer of ownership or a tax efficient, kind of bonus program on a sales transaction. And so really documenting those things, papering them just helps the transaction go much smoother and ensuring that that the founder is well prepared in advance. And so those are things that we would generally see doing. And then with tax rates potentially changing and the state plans changing, that's the other item that we would generally advise clients on, probably at least a year out, is saying, let's get a valuation and let's consider whether or not a transfer to your heirs should be done, even pre-sale, pre-transaction, and what that looks like. So if you're contemplating something, 12 to 24 months out, you're perhaps going to have a lower value today than you may in 24 months, and we can get assets out of your estate before that transaction occurs.
Super helpful. Yeah, and I imagine with all the talk around potentially significant increases in capital gains, I imagine you're pretty busy right now tackling those types of questions.
Absolutely.
Great. Well, Jeff, I'd love to loop you into the conversation, maybe pivot to a topic that's near and dear to our hearts at Montage Partners, which is financial due diligence.
Everybody's favorite.
Kind of wrapped within this broad topic of financial due diligence is another one of these terms that people may not have ever heard of, but is an important part of many transactions, which is the concept of a quality of earnings assessment or a quality of earnings report. Can you kick off with just explaining what that means, what a quality of earnings is?
Sure. Quality of earnings is over the years sort of become synonymous with financial due diligence. And it's really the buyer's confirming everything that the sellers have told them through the various meetings and documents and things that ultimately have been shared through the earlier portions of the process. So an accounting firm like CLA or a due diligence firm will have a transaction services group. They go in and they get a whole bunch of data and information from you, trial balances and revenue files and all of those types of things, and put together what's called a quality of earnings report, which is a snapshot of the historic part of your business, normalizing for any strange things that have happened, normalizing for unreasonable compensation, unreasonable terms from your related party rent agreement, to really try to boil down your historical data to what should be the starting point of a new owner's financial model. What is it going to look like for me when I own this business if I strip away sort of all of the things that happen inside of a private business, and then that report then gets created and shared with usually banks or other lenders in order to raise capital to complete the transaction.
Got it. So the financial due diligence firm is engaged by the buyer. If I'm a founder seeking a liquidity event, what kind of interaction do I have with your team, and what sort of things should I be thinking about to be prepared?
Sure. It gets pretty intense. It's usually towards the back half of the transaction. So if we think about the transaction life cycle, there's a lot of ramp up to the point where the LOI gets signed. And then from that LOI is sort of this truncated period of time, usually 60 or 90 days, where all the advisors come in on the buy side, which we would be one of in the buy side quality of earnings. So that's where it gets pretty intense, probably for about 4 to 6 weeks, where there's a lot of information comes our way, and then we're doing analysis and asking a lot of questions, and then we issue our report, and then that all gets sort of rolled over to the legal group to kind of get into the purchase agreement. To get prepared, I'll say that the best way to get prepared is to actually do a sell side quality of earnings. They've become incredibly popular in transactions where instead of waiting for the buyer to hire the accounting firm to come in and do their work, we'll usually get involved on the sell side. It's about half the business that we do in the transaction services of CLA is working with our clients a year before they would go to market, essentially doing the same procedures on our client before they go to market, so that we can understand what it is, what buy side is likely to find. We're able to normalize things for stuff that's actually in the seller's benefit, as opposed to waiting for the buyer's group, which tends to be a little stingy on things that would potentially benefit the seller. So really getting to that normalized number, identifying any particular issues that that buy side is likely to come up with, so that we can mediate them as best we can in advance. And then and in addition to that, because we're doing a lot of the same things that the buy side is going to do, you will in advance have pulled together the vast majority of the things that ultimately you would need for a buy side quality earnings will be done in advance of that chaotic period of time.
Yeah, that makes sense. And that might be part of the answer to the next question I'd love to hear your thoughts on, which is, given the quantity of different companies and transactions you've seen over the years, can you share some thoughts on when things have gone well and it's been a smooth process, why you think that was, and when things have been rocky or haven't gone well, why that may have been?
Can we close that?
Sure. Yeah, there's a lot of things. I'll say the biggest thing I would say is preparedness. From the time you get that LOI through close is probably the biggest example of how you can make sure that it's going to close and that it's going to go well. And that's in two phases. One is actually knowing what's coming. The biggest reason why I see a deal die is because you've had 3 months of negotiation with your potential buyer, assuming that your cash flow was $15 million because you weren't doing your accounting correctly. You had things that were incorrect. You were making bad assumptions, and you find out that your number's really 12 or some other number, or maybe it's 3 and 2, regardless. But what ends up happening is you end up having this 3-month conversation about the value of your business is X, and then the due diligence team comes in, and at the end they change it to something, and now they can't afford to pay that amount, and everybody leaves and walks away and is relatively angry with that. So being prepared and understanding sort of what the buy side is likely to find is very helpful in sort of setting the right expectations and making sure that, because eventually they find everything. We're good at what we do. We are going to find out what the cash flow of your business is, and knowing what it is up front in many times can be helpful. And even just being ready from just being able to handle what we call the cadence of the transaction is incredibly important. The longer things take to come together, I always say that the longer it takes, the more risk that's associated with it, and the more scared a buyer is going to get, as a general rule. So if you start and you are ready and you're turning those monthly financials, because you're going to have to roll that forward through the process a number of times, if you're responsive to their requests and you're able to get them good information, timely. Everybody feels more comfortable. They don't feel the need to dig into all kinds of different things, and you just start to build towards a close. When you have lots of stops and starts and lots of, I'll get that to you 3 weeks from now, all of those types of things just tend to sour the deal and make it last a little bit too long. And those are the types of things that tend to make people walk away as well.
All makes sense. Well, thanks, Jeff. Mary, I'd love to bring you in here. And if there's one other party involved in a transaction that may be as focused on financial due diligence as an equity investor like us, it's a senior lender. Can you share some thoughts on the types of things as a senior lender when there's debt involved in a transaction that your team's looking for?
Yes, thanks, Jordan. And Jeff, you hit it out of the ballpark as far as the quality of the financials. I mean, that is one of the first things that we look at. We look at the financials and we determine, is this going to sustain going forward? Is the new management really? We look at the buyer and say, what value are you bringing to the table, right? So as Jeff has laid out, let's just say we have a great understanding of the financials, but what is this new management going to do? How are you going to keep things exactly as they are? Are you going to change things? What are you bringing to the table? What value are you going to bring that will continue the earnings perhaps as they have been in the past? I mean, many times in banking, it's about character, right? We look to the management team and that helps us determine how long, what's the future look like? So we have a whole new management team perhaps. We look at what value they're bringing to the table. So it's extremely important that when you're dealing with a bank, you're able to show that value. You're able to articulate your expertise, what your future looks like with this particular company that you're going to purchase and how you're going to go on and above. So it's really about knowing what you have in the beginning and then how you're going to create future value.
Makes sense. One of the things that Jeff talked about was how to head off potential problems or surprises during the transaction. From a senior lender perspective, can you think of a time when a company initially looked to be a good credit, everything was positive, but then something came up during the transaction or during your underwriting process where it became problematic, and maybe that something could have been prevented earlier? Any thoughts to share for folks who have built a successful company looking for a liquidity event on just how to head off potential problems during that transaction?
Well, I think the seller certainly needs to have a very good understanding of who the buyer is. Sometimes, we do background checks. We do quite a bit of due diligence, depending certainly on the dollar amount that we're going to be lending. And if there's something that perhaps your seller doesn't know about the buyer, that could create some difficulties. There could be some past credit problems, perhaps. Both parties, I think all of our panelists have been very articulate in stating that the best way to go into a situation like this is for everybody to have a really good understanding of who they're dealing with, right? The more you know about that person, the less surprises. And yes, I have been in situations where things have blown up because perhaps the buyer is not as forthcoming as they have been, early on. And then when the bank starts to really peel back the onion and ask some good questions about management, about their history, we find that perhaps they don't have the strength to carry forward in the transaction. So it's very important for the seller to clearly understand who they're selling to.
That's great advice. So it sounds like it's not just a question of financial statements, but it sounds like very heavy focus on the people involved from the lender's perspective.
Very much so. Cash flow, we always look at cash flow, but character still stands out.
Yeah, I think that resonates for us. We share that view. Yeah. Well, JT, would love to get you involved, and it's sort of fitting that we're kind of turning to you last, since in the sequence of how a transaction might flow, if I've built a company and I want to embark on a sale process, and I'm I'm going to see a large amount of cash hit my bank account on closing. Can you talk a little bit about the role that you guys play in a transaction process, when you would typically get involved, and sort of any advice that you might have for me as a seller on things to think about prior to closing from the perspective of what I'm going to do with those proceeds post-close?
Yeah, absolutely. And Jordan, thanks for having me on the panel. So, at the end of the day, we, do come in on the back end of a transaction and help the business owners determine what they're going to do with the liquidity that they are able to take out of the business through the transaction. But everyone on this panel has said the earlier we're involved, I think the better, and the better outcome that you're going to have. So while we're definitely part of a post-transaction team, if we can be part of the pre-transaction team and understand what a client's and business owner's goals and objectives are going to be after that transaction, the better outcomes everybody's going to have in the process. And so whether it's $20 million, $100 million, or just $1 to $2 million that hits the bank account post-transaction, business owners have reached an important milestone in their lives, and they have new challenges and new opportunities that they're going to face. And so our goal is to help those business owners understand what the future might look like and how do they accomplish all their goals now that they're not potentially actively engaged in the business. And how do you replace the cash flow that you've counted on from the business with income from the portfolio or other balance sheet items? And so we do a lot of due diligence with our clients to understand what their balance sheet looks like, what are income producing assets, what assets are not income producing, how can they benefit from both those assets to make sure that they efficiently and effectively get from point A to point Z, which is meeting all their financial goals and objectives. One thing that's unique about business owners is, there's a lot of people out there that through consistent savings and investing build a nice nest egg at the retirement. But business owners are unique. Often they're pouring so much of their capital and so much of their risk is within the business that they're really focused on wealth accumulation through that process. And it's a great wealth accumulator when you're concentrated in a business that you have control of. But as they transition to that next stage of life beyond business, we find that that pivot needs to take place where you go from wealth accumulation mode to wealth preservation mode. And the best way to accomplish wealth preservation is often through prudent diversification, building out a portfolio that's tax efficient, that has exposure to multiple different asset classes, and can help you weather storms that you may face in equity markets, in public markets in general.
That's good advice. It's easy to imagine that if I've been focused for the past 20, 25, 30 years building my company, and I've just been grinding it out for the past 60 days on a transaction process, I'm probably mentally focused on getting to the goal line on closing day. Wire hits my account. It's probably a very emotional day. It's great news. But the reality is there's a lot of important decisions once the dust settles on how I'm going to reinvest that capital, how I'm going to protect that capital, how I'm going to be tax efficient. And you've touched on some of those things. Back to this objective on our side of addressing definitional terms that people may have never heard. Can we talk a little bit about rolling equity, what that means to roll equity? If I'm a founder, I've built a company, and a buyer makes an offer to buy my company but asks me to roll some portion of equity into the transaction, what that means and what are some of the pros and cons of that from my perspective as a seller?
Yeah, absolutely. So rolling equity simply means that, founders or key team members are going to be asked, or maybe they desire to take an equity stake in the new capital structure in lieu of taking cash out of the transaction. And so when you think about rolling equity, everybody's situation is going to be different. But buyers are often requesting that key members of a team roll equity in order to make sure that if that management team is going to be part of the organization going forward, that the investors and the management team's incentives are aligned, and that you're all working together towards, you know, future growth and a common goal. And so it's kind of keeping people's attention and skin in the game. From a seller's perspective, it might be attractive because you can take some money out of the company, or monetize some of the value that you've worked so hard to create, get some liquidity, but also retain some of the upside in the future growth of the company. And so there's definitely pros on both sides. As a, you know, a seller of a company that you've built, if you're going to roll equity, I think there are some important considerations. One would be on the tax side. Does the rolling of equity result in a tax deferral on that piece of my payment? So, you know, I'm taxed on the cash that I take out of the business, and Christina could help with something like that. But then on the equity that I roll into the new capital structure, do I have the ability to defer taxes for some time until another liquidity event or monetization event? With regards to corporate governance, you know, what say will I have in the business on a go-forward basis? What sort of control do I have in decision-making, both financial and operational? And then how has my partner, the buying organization in this transaction, treated partners in the past? So, you know, everything's about character, right? And Mary mentioned it. So can you do some references or background checks on, or just have conversations with organizations or leaders that have gone through this with the organizations that's making the acquisition? And then on the debt side, you know, making sure that you understand if there are going to be any personal requirements or personal guarantees that are required for debt on a go-forward basis.
Yeah, that's fantastic. Thank you, JT. And we're going to jump into Q&A here shortly, but Brooke, if it's okay, I'd love to circle back, Christina, to you and talk about one other topic. It's a little off script, but it's one of those things that if I'm a founder of a company, I haven't been through an M&A process, I haven't dug deep into tax planning, but I may have heard this term out there. I'd love to just sort of clear it up a little bit, and that's the concept of a Section 1202 exclusion. Realizing we don't have a lot of time to dig deep, and there's a lot of specific nuances as to how a company qualifies for a 1202 exclusion. Can you just hit the basics for somebody that maybe it plants a seed and they can do some more work into whether they may or may not qualify? What is a Section 1202 exclusion, and why should I care if I'm thinking about selling my company?
Yeah, great question. So a 1202 exclusion basically allows you to not recognize any tax on a portion of the transaction, or potentially all of the transaction. And so the exclusion's up to 10 million. There's a bunch of nuances as how you calculate that 10 million. But basically, if you are a C corporation, and when you founded your business as a C corporation, and you're a qualified C corporation, meaning you're not healthcare or an accounting firm or a legal firm, and there's some other nuances around that, then in essence, you can potentially avoid tax on the sale of your stock. And so again, it has to be a stock sale. You have to have C Corp stock that was issued kind of day one. And so, for example, we went through an exercise with a client just this last year who, you know, they had 10 founders and you know, 3 of the management team who joined maybe a year or 2 ago. And so the 10 founders were able to take a 1202 exclusion on their sale, but the team that came in, you know, a couple of years ago were not able to, because that was not original issued stock the way they had transactioned the sale of stock between founder group to the next group. And so again, it's a great way to, you know, if you check all the right boxes, to really maximize cash flow on an after-tax basis on a C Corp stock sale. There are other things too, Jordan. There's, you know, tax elections like a 338H10. There's personal goodwill. There's lots of different kind of tax planning strategies depending on your structure that, you know, certainly if you're working with a tax advisor, can help you determine, do you meet any of these kind of nuance or specialized areas to take advantage of a reduction of tax on sale.
That's perfect. Yeah, both the 1202 exclusion and the 338H10 are probably good things for those who are listening who aren't familiar with those concepts, just to note and maybe follow up on with a tax advisor to figure out whether or not they may qualify, or it could somehow apply to their transaction, because the stakes are high and it could have a very substantial difference on a once in a lifetime event for a lot of people. So appreciate you giving a primer there. So with that, I think we're at time, and it's time to pivot into Q&A. So Brooke, do you want to select a question to kick off with?
Sure. So I'll go ahead and start with this question. I'll direct it to you, Andy, but if anyone else has something they want to add, just feel free. We have a question of how long a transaction usually takes, and I know that that can vary widely, but basically, how long does a transaction usually take in your experience?
Yeah, so it depends what you want to call the start date of your transaction. Let's take it in chunks. I would say probably from the time you sign a letter of intent or a term sheet, most transactions are 90 to 120 days from that point. So that's three to 4 months. But if you want to go back to maybe when your due diligence process started, or maybe even when you first met your potential buyer in the transaction, I mean, you could be talking about years. And this goes back to things that Mary and Jeff and Christina talked about too, is being comfortable with the buyer, knowing their business, understanding what their plan for the business is. That can be a very long process. But when you really get to the heart of it, from letter of intent to closing, that's generally in the 3 to 4 month range.
Okay, Jeff, do you want to add something to that?
Yeah, I think so. We have a number of meetings on this, and usually what I tell everybody is from the time they look at their investment banker, if that's the route you're going, from the time you hire an investment banker to close is usually going to be 6 to 9 months, and probably towards the back half of that, maybe up to a year is sort of the standard, I would say. If you're ready, if you go through everything, no hiccups, no things like COVID blowing things up in the middle, all that stuff, 6 to 9 is pretty standard.
Excellent, thank you. So another question, and Christina, I'll direct it to you. So the question was, what is the hit or miss rate on transactions? So I think to clarify, that's how often do transactions close versus, you get down the road and it ends up not going through?
Yeah, I think the success rate will vary depending on how prepared you really are for the transaction. And so sometimes, a company kind of dips their toes into the market thinking, well, my friends are exiting, or I hear it's a great time to sell, and so let me see what's out there. But they're not really prepared to give up their business. They're not really prepared. They haven't really prepared their business for that transaction either. And so they've not, done key things like having a key management team in place, or how will that transition occur with the buyer group. And so it's a really one of those depends questions, but success I think can be very high as long as you get to know your buyer soon. You're very transparent with them, you're upfront with them, you provide them clear information, and you have all of your information ready to go, ready to roll. And so I think a number of people, Jeff and Andy certainly have talked about, if you have clean records, that transaction has a really high success rate of actually occurring in closing, and can happen quite quickly once all parties do their diligence.
Okay, thank you. And anyone in the audience, if you do have additional questions, just feel free to put it in the question box now. But so another question, JT, I'll direct this one to you. Is rolling equity the same as an earnout?
No, it's not the same as an earnout. An earnout's going to be, basically governed by, do you hit certain metrics, financial metrics over time that allow you to achieve, a second payment or a third payment down the line. So you may not continue to own any equity stake in the business, but you have stake in the future of the company, because the better it does, the higher your second tranche of payment.
Perfect, thank you. I will direct this next one to Mary. Again, anyone, if you want to add to it, it's kind of a bigger one. How important is it to have budgets when selling a business that has over 30 years of actual financials?
Well, it is important. As I said earlier, what is the new buyer bringing to the table? what are you going to do differently? Are you going to create new efficiencies? Are you changing a marketing strategy? Is your plan to grow quickly and to then sell? I mean, it is very important for the bank to have an understanding of what you're going to do from the point that you take over to wherever your exit strategy might be. It's very important. It's very important from a structure standpoint of how we might structure a loan, you know, based on what you're planning to do with that organization. Even if it's, you can have an organization that's been extremely successful for 30 years and crater in a year because new management doesn't understand the business. They don't understand why that company was successful for those 30 years, and you're going to change it all up, and you could, you know, go crazy wonderful, but you also could go the other direction. Very important for the bank to understand exactly what your strategy is.
That makes sense. Thanks. And Jeff, did you have something you wanted to add from a financial due diligence perspective?
Sure. And I would say the budget's probably the most important part of it. Everything that they do around this, all the quality of earnings is just to support the budget. What they're paying for is the future cash flows of the business. So you might have 30 years of experience, but what you get paid for is what the company is going to do over there, if it's private equity, what the next 5 years are going to look like. So understanding the growth trajectory, what growth trajectory is in your business and where you're going to and have it be supported can make a very big difference in how much the multiple side of the equation. Even it might still be the same, but whether you're a 5, a 6, a 7, or an 8 times that multiple is going to be very determined on what that budget looks like for the next 5 years.
That makes sense. I think that's all of our questions, and we're pretty much at time. So I think we'll transition over to the, oh, sorry, we have one more last comment. JT, do you want to add something to that?
Yeah, I just want to add in, everybody on the panel said the same thing. The earlier you can get experts involved in this conversation, the better, and the better outcome that can come of it. So I would encourage anybody who's thinking, hey, I'm growing a company, it's going to benefit me and my family over the long term, to get people involved as early as possible and start modeling some of this stuff out, whether it's from a tax perspective or a cash flow perspective. And depending on what the outputs are and the outcome of those models are, there may be things that you could do early on that can substantially, you know, transfer value to your next generation. If you think there's enough value in your company that it's going to support your lifestyle, you might be able to use estate planning strategies and work with an estate planner to implement a plan that freezes the asset value and passes assets appreciation, gift and estate tax free, to the next generation. And so these are things that are possible, but not if you wake up one day and think, I got this offer that's too good to be true, I can't pass it up, and I was never prepared.
Makes sense. Thanks, JT. And actually, we do have one more question. Jeff, I'll direct this one to you. How many years back of financials does a new buyer review when buying a business?
They usually go back 5 is the pretty standard one. If there's always special circumstances that actually maybe, you know, there's weird things that have taken place where they want longer, but 5 is pretty standard. And then when you get to the diligence where they really dive in, it's usually the last 2 calendar years and then what's called the trailing 12 months. So we're coming up on May, that would be, you know, your June 2020 through May 31st financial statements. So it just continues to roll throughout the process. That's what we'll diligence.
Perfect. Well, thank you to all of our first panelists. We will go ahead and transition at this time to our founder panel. So if the founders can turn on your cameras and we can, we'll move into introductions with them. I'll pass it over to Jordan.
Great, thanks, Brooke. Hi, Dean, Mike, Lauren, Martin. Great to see you. So I'm going to do some quick backgrounds here before we jump into the discussion topics. But before going into bios, just want to thank each of you for joining. I know each of you very well personally. I admire each of you, and I know you've got a lot of demands on your time. So it means a lot that you've carved out time here to share your own experiences and stories with those who may have never been down the road that you've already been down. And hopefully there's a lot of good insights and take-home value that people will get out of the discussion. So I will kick off, Martin, with you. So Martin Amons. Martin is the founder and CEO of SWDP, a manufacturer of data center infrastructure products that he founded in 1986. SWDP is headquartered in San Bernardino, California, and has a second facility in Manassas, Virginia. An interesting fun fact, Martin started the company with 2 employees out of a 500 square foot garage in 1986, and one of those 2 employees is still with the company today, which I think says a lot about the culture of the business that Martin has built that made it as successful as it's been. Today, SWDP is a little over 100 team members and serves some of the best known companies in cloud computing and co-location data centers. In 2017, after 31 years of hard work building the company, Martin partnered with Montage Partners in a recap transaction in which Martin received significant liquidity and also a partner to support growth initiatives as SWDP aims to continue to sustain its north of 20% annual growth rate. So I'm sure we'll hear more about that in a minute, but first, Martin, thanks for making the time to be here today.
Appreciate it.
Okay, Lauren, you're up next. Lauren Bailey. So Lauren is the co-founder and CEO of Upward Projects, a restaurant holding company with more than 15 restaurants across 5 brands, including Postino Wine Cafe, which most of us in Arizona know very well. Upward Projects was recently named to the Inc. 5000 list of the nation's fastest growing companies for the 4th year in a row. And in addition to leading a team with over 1,000 team members and building a company with a unique, positive culture focused on opening restaurants in historically and architecturally significant buildings, Lauren was recently named to Nation's Restaurant News Power List of restaurant leaders and was also a finalist for Ernst & Young's Entrepreneur of the Year in 2018. Lauren co-founded Upward Projects in 2002, and in 2017, the company completed a recap transaction with a Los Angeles-based private equity firm, Brentwood Associates. The transaction provided partial liquidity to the company's founders and is helping Upward Projects target a growth rate that will take the company to 50 restaurants in the coming years, including significant growth across Texas and Colorado. Lauren, huge thanks for being here and for sharing your story and experience with us.
Yeah, thanks for having me.
Dean Bloxham. Dean co-founded iMortgage.com in 1999. Initially, the company focused on joint ventures with production home builders. After the 2008 financial crisis, Dean pivoted the business to add distributed retail locations. And by 2013, iMortgage had grown to north of 2,500 employees and closing several $1 billion annually in new loans. In 2013, iMortgage merged with Loan Depot. The transaction created one of the 5 largest mortgage lenders in the US. Today, Loan Depot has revenue north of $4 billion and trades on the New York Stock Exchange. Dean remains involved at Loan Depot in an advisory capacity, but today spends the majority of his time managing personal capital, is involved in producing movies and also working with several startup companies. So fun fact about Dean, in addition to being an avid golfer, Dean's also a professional clogger. And when I learned that, I had to Google what it means to be a clogger. So maybe clogging will come back during the Q&A session. So Dean, be ready for that. Welcome, thanks for being here.
Thanks for having me.
Lastly, Mike Friend. So Mike is the founder of Integrity Mold, a Tempe, Arizona-based plastics manufacturer, providing custom injection molding and tooling services to customers with highly engineered plastic components, serving diverse end markets that include healthcare and consumer customers. In 2015, Mike partnered with Montage Partners. Montage Partners invested in Integrity Mold in a recap transaction that provided Mike with partial liquidity and a partner to help support growth initiatives. Plastic injection molding presses can be quite expensive. In 2017, Mike then led the sale of Integrity Mold to a strategic buyer, Westfall Technique. And as a sidebar, Mike's unique. Mike also successfully founded and built another injection molder prior to founding Integrity Mold. So a true serial entrepreneur, and has been through now 3 successful transactions that we'll hear more about in a minute. So Mike, super grateful for you taking the time to share your story and your expertise.
Yeah, thank you, Jordan, for having me.
All right, let's dig into the fun part. Lauren, I'd love to start with you. And if you could think back to 2016, when you and your team were preparing for a transaction, can you just share a little bit about what your objectives were at the time, what you were looking to get out of the transaction in the first place?
Yeah, thanks for having me, Jordan. It's exciting to be here with you guys and love hearing all the stories too of these paths because it's such an awesome journey. Craig and I, my partner, he was a bartender and I was a waitress. So I think we started with the whole thought process of if we have more than one restaurant, we will satisfy our parents' quest to know what we're doing with our career. So that was like stop number one. But over time, we had really built the company on a shoestring. And I mean that in the terms of like borrowing money from everybody we knew to using credit cards, second mortgages on the house. And we did that for 10 years. And so the great thing was that we maintained all the equity in the business. But the negative was we were literally like not paying quarterly estimated taxes because we had a restaurant opening and we had a need for infrastructure. And I met this woman who told me that some of the best advice I got, which was you should do a deal before you need to do a deal. And we kind of started to realize that we had a tiger by the tail with Postino and wanted to grow it. And we wanted to find a great partner that we chose, not one that we had to have. And so that was really important to us. And we started down the path of really understanding the players, who they were. And we actually knew the founders of Snooze, which is a restaurant maybe many of you have been to, and they had recently done a transaction. And so they cared about their company in a similar way that Craig and I did. And we got to watch how that happened and who they partnered with. And so what we wanted ultimately out of it was to take some chips off the table because, again, we had really leveraged our own personal finances for a long time, but then also retain a significant ownership in the company and then have a capital to grow and scale and add infrastructure. And so those were really our goals with a partner that was known in the industry to be really supportive of that and have not just capital, but also intellectual capital, because we had never been where we were at that moment and where we were going. So we really wanted to accomplish all of those things with the transaction.
Makes sense. And so by 2016, you built a pretty well-recognized, significant brand, 14 years of hard work building the company. Can you talk a little bit about any fears that you had as you were embarking on a transaction process of what could go wrong that might disrupt all the things that had gone well over the prior 14 years?
I will preface this answer to this question by I'm an internal optimist. I'm tamping it down for you guys right now because I don't want you to think I'm on drugs, but like I loved this process and everybody told me that, batten down the hatches, you guys are screwed. Like this is going to be super distracting. It's awful. I loved it. And I think the advice I would give in this moment is just to remember how special it is to have a seat at this table and to be able to build your business to the point where someone wants to invest in it. And certainly private equity groups, that's what they do and they're pros. I remember walking into some of these huge companies in New York and like poking Craig and being like, oh my God, can you believe that we're here? Like I'm a waitress and you're a bartender and someone wants to invest in our company. And I think it's important to remember that like throughout this whole process, because it is hard and it is challenging, but to really control your narrative around that whether you do a deal or you don't, going through this process is such a huge educational moment for how investors look at your business, the accomplishments that you've made as a leader and a founder, and also what your team's done. And keeping that really close to me really helped me get through those days of like where the fears lied. And I think the biggest fear was like, we're going to partner with someone who wants to fundamentally change the business, or they're going to come in, we're going to close this deal and day one, they're going to say, can't do Battle of Lip Sync bands anymore, which is a huge party that we host every year where we close all the restaurants and do a lip sync battle with our team, and it costs the company like $100 grand. And those, my fears were that we would have a partner that would shine us, that would be like, oh yeah, we think it's great, all this crazy stuff that y'all do, and they would take that away. Or that they would pressure us to take away the very intention of how we built the brand and why it got to this point, which was creating value for our customers in a space that was really special. But again, I think for me, I always thought that if we were in a position to walk away, we would make sure that we assembled the team that you just, similar to the folks that you just had on before, that would help guide us to the place to get to the right people. And if we were always in a position where we could walk away from the deal, that would squelch those fears as well.
That makes a lot of sense. And I've got to point out how humble you are, Lauren, because I know how successful your company is, how unique the culture is, and the brand that you've built. And you know, the way you tell the story is one of sort of gratitude for the process. And I'm sure that all the buyers you were talking to were excited and grateful to have the opportunity to invest in your company. In your case, you hired an investment bank to represent you. Can you talk a little bit about that decision, why you decided to hire an investment bank, and how you ended up choosing the firm that represented you?
So I'll be honest with you here, like we were not in any position to do this, and the amount of things, like I said, that we learned going through this process was great. And I think both my forum and Craig's forums had a few people had sale events, and they told us, you guys are awesome at a lot of stuff, and this isn't one of them, and you need to hire a banker. And that was real talk. And I think having those relationships where people will tell you the truth is like so critical to staying on the right path. And then I had a mentor named Alice Elliott, who is a headhunter in our industry, and she's from New York, and she's like, Lauren, I love you, you're awesome, but you need to hire a banker. And here's why. Primarily, you know, you don't even know what you don't know going into this. And I think they touched on a lot of this in the prior session, but these bankers act like a hybrid of a therapist, a coach, and having intellectual property around what these do. And if I told you I talked to our bankers, I mean, I had no clue that I would literally talk to these guys every day. Our deal went on really long, and someone said this earlier, but the longer the deal goes on, the scarier it gets. We had a trademark problem, but it went on for 18 months. And these guys were therapist, coach, advisor, the whole step of the way. And I remember talking to Chris Sims, who's the CEO of Lazy Dog, and he told me, because you had to peel me off the ceiling when they told me how much their fee was gonna be. And I was like, what? Like, I couldn't even believe it. I was like blown away. And Chris said to me, Lauren, the thing that's important that you know is at the 11th hour that these guys are going to get you a higher valuation. They're going to protect you against retrades. They're going to talk you off the ledge when you're like, things are kind of winding up or winding down. And that advice was so true. And I think knowing that you just don't know the path, you don't know the deal structure, you don't know the tax implications, you don't know the things that kind of happen at the end where, you know, for us, we were going into a downslope for same store sales, which is something that is a real trackable deal point. And at that point, most private equity groups probably would have retraded us, and they kind of handle that for you. It's a middleman. It's like you get to be the good founder and you're so excited to keep growing the business, and they kind of get to be the bad guy. And I definitely think if this is your first deal, that is by far and away money well spent. And at the end of our deal, when all the bids were coming in, it's really this like beautiful art that they do. And those two guys, Damon Chandic and Carlos Sanchez from Piper Jaffray, I still talk to them. That was the one thing that was awful. Like once our transaction closed, I was like, wait, we're not going to talk all the time. So I still call them, and I love those guys, but I would never do a deal without a banker, because whatever money you think you're going to save, I guarantee you will lose it. And not to mention your sanity. And they were definitely a therapist for us along the way.
Got it. What about internally? So one of the trickier components of going through a sale process is how to navigate communication internally with team members and other stakeholders. It sounds like your transaction went on for 18 months. How did you guys handle communication internally before, during, and at closing of the transaction?
So I wish you guys could see what's going on out there right now, because there's probably a Nerf gun fight going on and something else that's like not traditional like work environment. So just keep that in mind as I give you this answer. But our team, we've always valued transparency, and so the whole time we're growing this, we've never really hidden things from our team. And we talked about the fear that this would elicit in terms of them finding out that we're selling the company. And so right away, I changed language around that, because I think that's a critical mistake that companies make, is they start saying we're selling. And we what we were doing was, I mean, different than, I guess, maybe some transactions in that we weren't selling the company. We'd kind of done this backwards in that we never took investors along the way. And so really we wanted to bring on an investment arm into the company. And so right away, we were very careful about the language that we chose. And I made the decision that we were going to be fairly transparent about this from the get-go. I mean, you have to think about too, these guys are creatives, they're restaurant folks, they're aware, and you can't have what appears to be like the FBI rolling up into the company. They're literally pulling up in black Escalades, wearing suits, coming into the business and think that your employees aren't going to start wondering what's going on. And so I'm always a fan of transparency in that. And I think the key piece is really giving them something to hold on to. Like, you guys, I want to let you know we're going to be exploring an investment. We want to grow. This provides a ton of opportunities to you all. And we've never taken an institutional investor like this, and it's important for where we are. And I think that helped them get excited about it. And I talked often about what this was going to do for the company, because each and every person in the business at that point was feeling some kind of pain point. So I tried to create a picture of like, hey, we're going to get to move offices where you're going to have your actually own desks. Literally, people were sharing desks at that point. We're going to have a CFO. We're going to add resources here and here. And they started to be like, wow, you know, I can see myself in this future place. And so for us too, and I said, you guys, we're going to continue to run the company. The only thing that's going to change is that Craig and I aren't going to be using credit cards to open restaurants. And I think from my standpoint, giving your employees enough to where they have something to hold on to and they're not piecemealing this together. We're like, oh my God, Lauren and Craig are selling the business and they're going to be out. And for us, nothing really did change. I mean, Craig had been taking more of a backseat in the day-to-day operations for some time. So there wasn't a big departure from our day-to-day, but I think word choice is critical. I think that transparency at the outset is important, so that people have that storyline to say and something to hold on to was really important for us. And that we reiterated also how carefully we were going to select these people. And we always positioned it that it was our choice, that we were going to find a partner that met with our core values, and we reiterated that often within our teams.
That's great. Well, the topic of the importance of the people who are involved keeps coming up over and over. On that note, so you're 3.5 years, I think, post closing of your transaction, roughly. When you look back now, how's your relationship today with your private equity partner relative to your expectations 3.5 years ago?
I would literally do anything for those guys. And I think going through that process, the way we did it was so critical. They've been so additive to us. I know this is going to sound like BS, but it's really not. I would do anything for those guys. And they have added so much to our business. They've been respectful. They have opened up doors for us that we wouldn't have otherwise had. I mean, through COVID, you know, what's that saying where they say troubling times shows integrity and success hides low integrity. And I think that was definitely one of the times where we saw these guys really stand up for us and take risks. And for us with the PPP loan, there was a lot swirling around what did that mean for private equity owned companies. And there was a special exception made for restaurants, and a lot of restaurant companies, private equity groups didn't take that money, and it was really critical to our survival, and there was risk around that for them. And they stood up for us, not just for that, but instantly created a CEO call where we were all helping each other, and they were just doing whatever they can. And I think the way that they've handled our business and the way that they continue to handle themselves, I called every past CEO and current CEO that they'd ever done a deal with, because I was that nervous about it, like you mentioned, and that was really helpful too, doing that. But the discipline that doing a deal, I think, forces you to, on one hand, is great because it forces you and your team to take a look at your business every month. And it can be, I think, kind of a problem because you sort of get too much information where it influences decision making. And in the restaurant business, when you're presented with too much data, the data starts to drive the decision making, not like, hey, what's the best thing for the guest and the business? It's like, what's our food cost? What's the labor cost associated with that? And I think we have to be really careful with that. So we've taken a really balanced approach with them, and they respect that, of the art and the science. And I think they're very experienced in the restaurant space, which was another reason we picked them. They ended up putting capital on our balance sheet too, which was helpful to kind of keep the brain space away from serving debt covenants right out of the gates too. And they've been amazing. I think doing your due diligence up front about who these groups are, but again, being in a space where you don't have to do a deal, where you're calling the shots, you're prepared to walk away. I mean, no doubt you get pregnant with this. You spend an exorbitant amount of time prepping these decks, preparing for management presentations, and the thought of walking away from that is huge. But if you maintain, keep running your business, in hindsight, I would have known what these benchmarks were more clearly for our industry, of like what makes a marquee company, and kind of known where do we fall in that in terms of timing of doing a deal. And I didn't realize that this decline, this momentary decline in same-store sales would put a wrench in our system like it did. And I would have liked to have been more well-versed around that going into this. And they didn't ever retrade us, which was also a sign of their integrity as a group. But I think doing that, we also did, we had all of our forums come from YPO and EO who'd been through transactions, and we did mock management presentations, which I think was another huge thing that we did. And talking to them after the fact, they were like, you guys were one of the best management presentations that we'd seen with a first round group. And so I think that was a huge piece that we did. And just getting your pitch straight, I think that's important too, and being passionate about it. And I don't know, Jordan, if you feel this way, but it seemed like after the fact that these guys they're buying the company, of course, but they're really buying the management team first and foremost. And I didn't realize that until after the fact.
Yeah, the importance of people goes both ways. It's a big decision for everybody, and everyone should spend time to get to know the people who are involved. Mike, I'd love to bring you in the loop here. You're in sort of a unique position, having successfully navigated through 3 transactions now. Can you kick off with just a little bit of context on each of those 3 companies and sort of the nature of those transactions?
Yeah, sure. Thank you, Jordan. So I did have 3 transactions. And I think the underlying theme of working yourself up towards that transaction is typically, and this has already been mentioned in this panel, is that you've worked hard and as you say, Jordan, you kind of ground away and you spent all these years in a lot of the early years when we were buying capital, a decision had to be made whether you finance the capital or invest it personally. And I always said the best investment I can make it is in my own company. Okay, so you put a lot of time and energy and effort into building something, and then one day you wake up and you look at your personal balance sheet, and a big chunk of your long-term of your family net worth is in a company, and it is illiquid. Of course, as we know now with COVID, things can change in the marketplace, and so the whole idea of being able to pull some chips off the table, go through a transaction, and get a liquidity event, which will help you in your long-term financial goals. So that's always been, I think, the underlying theme, but there were 3 different triggers in my transaction. So back in the year 2000, we had a pretty good sized company. Of course, 2000 was kind of a frothy year on the public market, a lot of people calling, wanting to buy companies and everything. And we kind of discounted that, but internally, I had a partner that was like 15 years older, and he had been in the hospital twice in the prior 6 months. One time it was almost a near-death experience, and we didn't have a good buy-sell agreement. There were some other things that we said we should go through this process and let's sell this company. And primarily because of an age difference and different. So we went through that, and that was a financial buyer. It was a roll-up of plastics companies throughout the United States with the idea that they would buy several of these companies in a fragmented industry, and through that consolidation, they'd be able to pick up a lot of accretive things. So we went through the transaction, it closed. My partner was totally satisfied, and he ultimately retired, and he was financially secure. I was a lot younger, and I wanted to continue on with my career. So, which leads us to the second. Now, the thing I'd like to point out about the first transaction, the buyers roaming around in the year 2000, they wanted to buy your company, and they didn't want you part of the new company. That was pretty obvious back in those days. We'll buy your company, we'll put you on an employee agreement, and I mean, you could have earn-outs, which we talked about earlier, which is a separate item, but primarily it's going to be their company, you're going to work for them, and that. So we started another company in 2005 with a bunch of younger partners. And so we go through a 10-year period. It was actually, we started the process a couple years earlier, and that was commented on. So we actually engaged an investment banker in late 2012 and 13. And they came out of Boston. They came and looked at our company, and the guy jumps across the table and says, I love your company, but we're not selling your company for another year and a half. We got a lot of work to do. And I said, so you're going to advise me on that? He said, absolutely. He says, we're going to clean up, we're going to start forecasting. We had compiled financial statements. He says, that's terrible. We're going to go to reviewed statements. We're going to go to audited statements. We got to clean up your financial statements. And I already been through the process back years ago. So it kind of all rang true with me, but that process took a while. So in 2015, the buyers out there were not interested in buying your whole company in our space, manufacturing space like we are. They primarily wanted to do recapitalizations and come in, and it's a great idea because I had a younger partner, and the trigger was he had a daughter and she wanted to go to college, and all everything he put his whole life into was this company, and he didn't have a lot off on the side. My retirement was on a glide path. I had pretty much through my first transaction set me up so that I'm going to be good, but I wanted to keep working, and I did. But my younger partner, and for his interest of being able to have a liquidity event, so we did the recapitalization. And the interesting thing about that, which you probably all know, is so you're bringing in other partners, and now you create this new entity with the idea that, hey, we're going to go down the road and we're going to build additional value, but you've de-risked yourself. And that's really the other underlying thing, is that when you go through these transactions, you get a liquidity event, you pull liquid assets off the table, and then you've taken all this uncertainty out there that could happen. But in the case of a recapture, you're still in the game. And they use the term taking the second bite of the apple. So we're going to do this recapitalization. We're going to go down the road, create more value, and someday we're all going to get exited out. So that was in 2015. So we were, Montage was our new partner. So and those were interesting times. We formed a board of directors, which we were on. We reported monthly. We had monthly calls. We did forecasting. We did all the things a real company would do. And but we were approached. So we get to 2017, and we were approached by a strategic buyer with a private equity based, and they made an unsolicited offer on our company, which was almost too good to be true. So again, it was all those same characteristics. It was the liquid event and this and that. We did roll over equity. We wanted to be part of the new company. We bought into their vision. So that occurred at that time. Primarily, the trigger for me is this bigger strategic company could offer more assurance to my long-term employees on succession planning. It gave us a better ability to track customers domestically. We started in Phoenix and became kind of a regional manufacturer, but we wanted to do more national sales. We like the way we compete on a national basis in our products, but we had trouble getting any interest of people in the far east, in the East Coast of the United States. But so with the strategic buyer, it was succession planning. It was sales, but it was also retaining skilled people or attracting skilled people. We had trouble. We'd run an ad in Chicago for a skilled mold maker. And even though someone up there could say, hey, that seems like an interesting thing, they're taking the risk of selling their house, moving to Arizona to work for a small $10 million company, let's say. It's a lot different if that ad goes in and it's a company that has 20 plants throughout the United States. And if I move to Arizona and I don't like it, maybe I can transfer to North Carolina because they have a plant there. So we saw a lot of advantages with potentially attracting skilled employees, which is a major problem in our country. So those are the three transactions. And each of them were different. I've learned a lot. Lauren talked about how fun it is. During the process, it's not, but afterwards, it's the merger guys say they love the dance. They love the process, and after you've been through it a couple of times, it's kind of fun. I would agree.
That's great, Mike. Thanks for the context there. Can we focus in on I guess the second of the two transactions that you went through, which was the 2015 recap of Integrity Mold? Having been down the road before, you were in somewhat of a unique position there. Can you share a little bit about what your objectives were and what the qualities you were looking for in a buyer were?
So again, the objectives were this liquidity event for my younger partner, but also because we were told by the investment banker that we really weren't running our company like a real company. In some cases, we weren't doing forecasting, we weren't having really quality financial statements. It was with a new group of partners, we had to be accountable at that level, and we were going to step it up in that part of everything. But put yourself, when I was in 2015, I've been running the company by ourselves, me and a small group of partners and friends, and all of a sudden we're going to have a couple other people in here, And that's concerning, like, okay, well, we got new partners, but who are these new partners? So in trying to qualify that, it really came down to number one, chemistry. Do we think we bring in these new partners, can we work our way through and navigate? Because business, as you know, is tough. I mean, you're going to get punched in the face, you're going to fall, you're going to have all these. And I always say, I can't be fighting my partners if I'm fighting off the competition. I don't have that much energy. You know, I have to be in concert with my partners and have good chemistry. Secondarily, it is the whole value thing. You know, we took a lot of time in 2005 on naming, and we came up with Integrity Mold, because we wanted to live up to that, and we wanted to deal with integrity and transparency and honestly and ethically. And we wanted to align ourselves with partners that had similar goals and visions and a good alignment of our value system. The third is this whole question of expectations. So we're creating this new company, we're bringing in these new partners, and we talked to a lot of people, Jordan, and some of them were just totally unrealistic about, oh, well, we're going to see this hockey stick growth and you're going to grow, you know. And I just thought to myself, so that's not going to work so well. I mean, I'm not saying we're not in a growth industry, because we are, but it's not this triple, you know, double digit year after year after year. So it's reasonable expectations. You know, let's put a reasonable plan in place, and then let's try to execute to that plan. Everybody knows that the whole idea of the recapitalization is you want to increase the value of the company, and that's going to be done primarily through quality sales, which will you have quality earnings, and there's some other little cost reductions and things like that, but those are kind of small ball. The big thing is to try to grow good quality earnings. And so that was the three characteristics, and we clicked the boxes off, and Jordan became our new partner.
Thanks, Mike. Any parting comments that you would give to a founder of a company who's embarking on a potential sale process for the first time?
So it's really interesting, and I'm sure all the other panelists and Lauren and this and that, you meet people and you tell them you sold a company, and all of a sudden everybody wants to talk to you because you don't, first of all, you don't get any good advice. There's not a lot of people out there that can give you advice. And particularly, and it will either all through the first two mergers. I mean, you can't find a lot of people on this that's been through this, and normally you only go through it once. So I tell people who are owning companies are going to go through the process. I said, you're probably going to go through this once. I was blessed to go through it 3 times. So, I bumbled around a couple times, finally learned some stuff, but you're going to go through it once. So make sure you do the best job you can. So the first thing I would say is make sure you prepare your financials properly, and make sure they're transparent, and make sure you understand this whole concept of EBITDA, which is bantered around that M&A world, and it never was bantered around my manufacturing plant. But understand what that means, and understand the concept of recasting away abnormal things. You know, my mother-in-law is on the payroll. Oh, I have all these extraordinary expenses. Take those off. Build a financial statement that the buyer says, this is really what I'm buying here, is this financial statement. We pulled away all these extraordinary things. The other thing is, and this is kind of touched on a little bit, but generally business owners I meet, they've gotten to where they are because they're pretty frugal, and they pinch the pennies, and they watch this and that. And that's a great attribute. But when you go find your investment banker or your merger attorney, you're not looking to save, you're not looking for the cheapest. You're looking for people who specialize in this. And I was with an investment banker in well, the first 2 mergers, third merger I had, Jordan, I didn't need one. But those investment bankers were very, very beneficial. And the first thing is to assign the preliminary indication of value, because I meet business owners. Oh, my company's worth this, my company's worth that. And I always think to myself, if you live in a residential base, you don't appraise your own house. So if you live in a community and all the houses are $350,000 and your house is just like everyone else's, you're going to sell it for $1 million? I mean, that's delusional. And some owners carry that with them. But the opposite's true too. Some owners don't really understand the real value, and they might. So you want to be well represented. If you want to be able to have a professional tell you what your real value of your company is, and that could be supported. But secondarily is this whole concept of your counsel. You know, there's different attorneys I meet, and there's litigators out there. There's people that can do real estate law, DUI stuff. I haven't had a DUI, but I'm just saying. But anyway, you want a merger attorney. You want somebody like Andy Western, because those guys are on this stuff all the time. They know what the current give and take is. They know what you have to give up, what you don't. They know all those things, and they're going to construct for you a merger agreement, a purchase and sell agreement that's fair. My first attorney back in the year 2000, he said, Mike, your merger documents are that thick. They're thicker than the Holy Bible. I mean, that's how much work went into that. And it was done by professional people. And this goes through every possible contingency that could happen. And just put it away. But you need competent people doing that. And I have seen some business owners that don't go very far because their brother-in-law was an attorney and he had kind of helped them out. I would definitely go for specialized support. Be mentally prepared for the due diligence. I know Lauren said it was fun. It wasn't so much fun for me. Once you sign on that, they come marching in and they take over your conference room. There's calls every day, all kinds of stuff floating around. If you can defer that to somebody on your staff, that's really good. That's great, because it will distract somebody in your organization. And if it's you, it's going to distract you from what you do every day. But be prepared for it. And the shorter the due diligence, the better. How you could do 18 months, Lauren, I don't know. But because you get this term they call deal fatigue. I think everybody just gets so beat up in this process that everyone kind of fatigues. And some people kind of say, is this even worth it or not? Keep your eye on the ball. And everyone's spending a lot of money too. I mean, the buyer's spending a lot of money, you're spending a lot of money, and navigate your way through. But when little things come up, your merger attorney and that investment banker can give you good advice. Don't ever get on the phone with the buyer and start talking about a legal aspect of your merger agreement. You don't know anything about that stuff. Stay away from that. No different than you don't talk to the person buying your house. I mean, they go through the real estate agent. You're being represented. You have good people. Let them do their job. Probably at most of the whole process is and during due diligence, you need to be completely, totally honest and take on that. You give no surprises to the buyer. It's kind of interesting because even though you're selling the company, you're not making a sales presentation to somebody. You're giving somebody information, the good and the bad. So let's just say you have a company and the buyer says, hey, do you have any turnover in the company or any problem with people? And if you're having people on third shift that you're turning over and stuff, tell them. Just tell them, say, hey, it's okay, but we're having some problems here on third shift. We can't get people to work at night and stuff. The thing is, they want to know that. And they also know there's not a perfect company out there. And it's already baked in the cake. Any problem you have in that company is already baked in those financials. They're buying a set of financials. So I would tell them, I mean, that was advice I got, and that's what we always did. And sometimes bad information you give them is actually good, because if 3 months after the merger, somebody comes in and says, I never knew we had this problem on third shift. Well, I told you. Everything should be out there. Everything possibly should be out there. One other thing that most business owners don't know is nobody wants your real estate but you. Okay, I mean, private equity firms don't want to own real estate generally. So if you have a company, and a lot of lawyers will have you buy if you have your own real estate, you would have that in an LLC renting it. That'll continue on, but they're not really interested in your real estate generally. And that's actually kind of nice. I mean, my former company, they're still running, it's doing well, and I leased the building to them, and that's good. So the last thing I'd probably say is that these people on the panel knows this, but your financial situation will change in the security and your long-term goals and stuff, but your work life's probably not going to change much. I mean, you might go out and celebrate a little bit, but most of us in that position have worked and probably will continue to do so. Particularly, I mean, on a recapitalization, you have a new group of partners. And I felt very obligated, and I felt, with Jordan's company, I mean, we're going to make this right. We're going to work hard because we know plastics and he knows finances. And it was an awesome partnership, and that would be another thing I would bring up to owners.
Yeah, those are great pieces of advice. Thanks, Mike. Dean, I'd love to loop you in here and talk iMortgage and the Loan Depot transaction in 2013. Would you mind kicking off with a similar question, which is, when you think back to 2013, you'd spent 14 years, you'd built a very significant company, a lot of success. When you thought about embarking on a sale process, what were your goals? What were you trying to accomplish?
Well, first is hard to follow those two acts. You two were great. Lots of great advice. I'll try not to be redundant because I was taking notes myself. But 2007, 2008, some of you may have remembered this little mortgage meltdown that was going on. It didn't make the papers much, but it happened. And, you know, that was pretty concerning time. And we were a good sized company, but still, you know, more like a mid-size. We did have a lot of volume and employees and good profit going on. 2007, 2008 were pretty hard on the mortgage business, to say the least. 2009 started to come back a little bit. 2010 was going well, but that's when all the regulation hit, because they were going to fix the big train wreck was the mortgage business. And Dodd-Frank came in, which was massive amount of regulation. It was, I'm trying to remember, but I think Dodd-Frank was around 1,000 pages thick. So to suddenly have a business that starts at that level of regulation, and then they created the CFPB. So that was very concerning for me, that how are we going to manage that, and what's going to happen to the mid-sized companies? Quite frankly, it didn't happen quite like I thought it was, but I was really concerned that that level of regulation was going to be very hard to manage. I only had at the time one in-house attorney. By 2014, I had 8 just to manage what was happening in the regulation. So right around 2012, I started looking for a partner that I thought would help us navigate through that type of change. And I love Lauren's attitude about taking a joyful approach to a transaction, but I do agree with what Mike said, is you still have this day job. So if you get into transaction, he was talking about one transaction that went 18 months, you still have the day job that you have to run your company, and make sure that you're doing a diligent job if you're going to look for a partner or sell or buy a company. And so it almost creates a second job for you. And so during that time, we were really searching for kind of a unicorn that would fit what we were doing. We wanted to continue. We liked the trajectory we were on, but look for somebody that could help us navigate what was completely new. At the time, I had been in the business almost 30 years, and that was a dramatic change that happened very, very quickly.
And Dean, after having that experience, is there anything that that you'd offer up in terms of advice on either things you would have done differently or things you learned during the process, where if you had spoken with someone or joined an event like this, you would have wanted to hear before you started the negotiation?
Yes. You know, Mike talked a lot about your financials. If I had to do it over again, I would have had a very high-level, strong CFO that had been in my company longer. I pulled that trigger too late, and I think a CFO can pay for themselves 20 times over if you have the right person, especially if you get into, you know, we're a pretty large company, and so that preparation in advance would have been helpful. I would say for us, you know, Christina was talking earlier, get great tax advice in advance. She mentioned 4 or 5 different structures you can have in your company, and then talk about different ways that you can sell your company, whether it's a stock sale or an asset sale. And if you don't have the right structure of your company for the type of sale you're going to do, or understand what all of those different transactions can do, you can end up in a very, very difficult tax situation. It worked out okay for us, but it took 7 years for that to happen, because I had to pay, you know, we were a C Corp, as Christina mentioned, which meant we had to pay double tax on it. Now, there was advantages to being a C Corp for the years before, pretty painful. And then there were assets that were valued that I had to pay tax on corporately and personally long before we got paid for them. The IRS is very, very skillful of getting their money in advance. And so I'm not saying I necessarily would have done it differently, given the ultimate transaction, how it worked out, but it was very risky because the amount of tax we paid within the first year of selling our company was pretty risky, because had we not ended up with the final bite of the apple, I would have spent the rest of my life trying to recapture that tax that I paid. So it worked out okay, but get great tax advice. You're going to hear from all of us. Spend the money. It it's nothing compared to the millions you can spend in taxes. Same thing with a banker. Get a great banker, get great attorneys. You will learn to hate them with great love. And if you don't get them in advance, you're going to need them later. So, and Lauren said, she choked on what she saw that they were going to charge, and I did the exact same thing. But when Mike was talking about deal fatigue, those people will get you through that, and you will achieve deal fatigue. It's almost inevitable. I hope you don't if you decide to sell your company or buy one, but if you do and you have those kind of strong people, they'll really help you through it.
Great insights. Thanks, Dean. Martin, I'd love to bring you in here to the conversation. I think it was 2016 you started thinking about a transaction. 30 years, you built a very successful company. Maybe if you could start with your objectives, what was on your mind, what you were trying to accomplish when you embarked on that sale process in 2016.
Well, for years, Jordan, by the way, thanks for having me on. For years, we had been approached by competitors several times to be acquired. And I resisted that because we felt we were in a lane that was going to experience huge growth over the next period of time for us. And we had laid all the groundwork as a company to grow into a very rapid growth environment, the data center market. And so what intrigued me at first with Montage is their approach, this partnership, rather than a full acquisition of the company and rolling it up into another company that's similar. I was highly worried about changing the culture of the company. The culture of our company got us to where we were at that point, and we were, it was just the tip of the iceberg at that moment. We had, like I had said, we had laid all this groundwork, and both myself and our employees were not going to be able to capitalize on what we've spent years developing if we were just going to be rolled up into another large firm and absorbed as a division. So the important parts were definitely to keep the culture intact. My employees, we have a mantra that our employees are as important as our customers. So when you take that view, you have to protect the employees in that transaction and make sure it's the right one for the company.
That makes sense. And the point around culture is a big one. I imagine a lot of people can relate to that. Now, 4 years post transaction, how's that played out? I guess, how did the fears sort of line up with reality, and how has your experience lined up with expectation?
Well, we had high expectations, but that was because I felt we spent a lot of time up front with you and your team setting those expectations, what the future was going to look like. So every month when we have our revenue calls and we talk about what the process is, it just solidifies that we made the right choice. It has lived up to our expectations in both maintaining the culture, maintaining the integrity of the company, maintaining the vision that we had as a company, to be able to make sure we perpetuated that, and then has given us the tools to be able to scale. We were very typical of a company. We had some rapid growth in a very high growth environment, manufacturing in the US, manufacturing in California, not an easy task in today's world. But it proved out what our expectations were. It is pretty much at every turn and reinforced that. Big learning curve. Again, I'm even at my age, I was able to learn quite a bit in that process. But we've been able to use the experience of you and your team to help us align and get our lanes straight and straighten out processes, and it's proven with our growth record so far. It's proven to be the right choice. And
Martin, if I'm, say, a founder on the call this morning, and I've similarly spent the last 30 years building a successful company. This would be a very big, monumental, emotional decision of bringing on a capital partner. Can you share any thoughts on what it's like to be partnered with a private equity firm? What's changed? What hasn't changed? And what's it like on a sort of daily, monthly, annual basis?
Well, it's given us some help in our vision. We've always had the vision where the company is headed in product, in client base, not always tied strictly to revenue. I had a vision of the company, and so did my management team, of what we could be as a company. And what it has done for us is allowed us to in a more organized fashion, set those goals on a yearly, 3-year goal, and then again quarterly and monthly. We never managed the company in the short term. We always looked very, very long term. So we made a lot of long-term investments, both in machinery, CapEx, but also in client relationships that we knew that would grow later on in the process. And it really allowed us to identify them and then focused how to get there, how to, the ways to be able to do it. You can't scale, you can't grow like we're growing without some structure. So it helped us bring that structure involved. I know Dean had mentioned about a CFO. One of the first things that your team suggested is we bring in a professional CFO. Light years difference in management of the company. It's helped us focus our process and make sure we're hitting goals and targets, and not just waking up that morning and going, what am I going to do today? What do I need to do? Where's our shortcomings? So it's just bringing that organizational structure and pushing us towards that. Sometimes I laugh because I feel for you, Jordan, sometimes, but I do need those pushes, those entrepreneurial skills that I have, that I've applied to the business. A lot of that shooting from the hip, and you can't always do that now that you have all of these employees, their livelihood at stake. You can't do that. You have to be able to scale it.
I imagine a lot of folks listening can relate to that. We're going to pivot to Q&A in just a minute, Martin, but any kind of parting wisdom, advice that you'd give somebody if you were talking to yourself 5-6 years ago, pre-transaction, that you'd want to share or would have wanted to hear then?
Yeah, I think if I had the advice, again, it's going to be a little redundant. We've already covered it. Is have the financials in place, have the right structures there. Like Dean mentioned, have a CFO doing that. During most of that growth phase, I was doing it myself, and it's that to be prepared for the transaction helps it. One of our concerns that I'll mention was the speed of the transaction. When Lauren mentioned that she spent 18 months in that transaction, I would get an eye twitch if that was the case. One of the great values that we found was the transaction, because we did some alignment and we had a good team pulling us through, both from your team and advisors. We were able to shorten the time of the transaction because that transaction time was critical as a distraction to what I was doing and our team was doing. We felt we were in that right at that cusp of moving ahead in some major lanes. We wanted to make sure that it wasn't a distraction of that, because as Dean said, you still had a day job.
Great. Well, thank you, Martin, Dean, Mike, and Lauren. That was fantastic. And I'm going to turn things over to Brooke. She's going to pull some questions from the Q&A box.
Yes, and if anyone does have additional questions they haven't submitted yet, please feel free to submit that via your question box. So the first question I'll direct to Dean. How did you approach the process of a merger differently than you would have to like a financial buyer, or outright selling it to or doing a recap?
Yeah, that's a terrific question. It's a double-edged sword. So Loan Depot was a a direct lender that was focused more on the refi business, and iMortgage was focused more on purchase business. So it was a great opportunity for a merger. That's how it created such a large company that melded well together. But iMortgage had a culture that was very specific, and though we were 2,500 employees, was very family oriented. So I worked really hard to retain that culture, and I think I made a bit of a mistake with that, because if I had to do it over again, I would have focused more on melding the two together than staying more autonomous. So one of the things that we haven't talked about a lot is the emotional part of selling your company. And if you're going to stick around, Micah talked about one time doing a second bite of the apple, and that's how we created our sale. And if you're going to do that, that means that you very possibly are going to stick around, but you have to be prepared for what that means. And in a company like iMortgage that was so culture driven, if I had to do it over again, that's the difference, Brooke, is that you really are molding two companies together, and everybody thinks they've got a perfect culture match, but I'm really not sure that that's completely possible. So that means it's going to be a new culture. So focus and be intentional about that. And I probably would have now, if I knew then what I know now, I would have done it more in that fashion.
Yeah, that's great advice. Thanks, Dean. Lauren, can you talk a little bit about any, one of the questions is the post-closing pitfalls you might have fallen into, and what would you have maybe done different, kind of easing into the partnership?
Yeah, so just to clarify, I loved the front end. I did get deal fatigue, and the back end was tough. We didn't do a good job understanding our own diligence. So they ran a trademark search, and it turned out there was a postino in New York, which presented a big issue, and that was the driver of the delay of our sale. So, I was flying back and forth to New York trying to solve that with that restaurant owner. And again, like getting to see that was actually a gift, because the private equity group that we were with could have just been like, hey, call us when you solve this. And they didn't. They kind of worked with us to help get it done. And we ended up writing them a check to get the ability to grow postino across the US. And I think just knowing those things is important, and what's important to them in the diligence process. And it would have been as simple as picking up the phone and calling someone like Jordan, or using our network, or someone like Dean, who didn't, any of these guys who'd done transactions before, and said, what should we be aware of? And I think that would have been time well spent for us, in particular, doing it with someone who had done a restaurant deal. Like I said, we knew the snooze people. But again, to me, this is like a lot of controlling the narrative. Like if you have this belief that things are happening to you and this is bad, like it's going to be that. And I think if you have the narrative that you'll get through it, and you'll use this as an opportunity to begin this relationship with this private equity group who wants to close as much as you do, because like someone said, they're just as deep into this in terms of spending as you are. I mean, they're spending a tremendous time of resources and money doing diligence like you are. I believe protecting the mental sanity that you have, not only as the leader of the transaction, but also subsequently leading your team, is really critical. And I think there's really rarely things that happen that are completely insurmountable. I mean, yes, you might have a retrade, the price might go down, the deal structure may change, people have change of heart, but I just don't believe that there's a lot of things that happen that aren't solvable in some fashion. And I think keeping that close is important.
That's great. Thanks, Lauren. Martin, can you talk a little bit about what you did operationally to prepare for the transaction process?
Well, because we were in a growth cycle all throughout the transaction, before and afterwards, we just wanted to maintain the integrity of the financials, the processes, not make any major changes or any market pivots at the time. We had already built those lanes in our process, so it was just for us, it was just a matter of expansion. We just didn't want to make any huge pivots during that period of time. We wanted to make sure that we focused on our goal, and then not let the transaction affect what we were doing, but make sure that we were providing value all the way through it.
Perfect. That's great. So it looks like we're at time. If anyone does have any additional questions, we're happy to pass those along. So what we'll do is we're going to send out a recording of this entire event. And then we'll also include our contact information. So if you do have any additional questions you didn't get answered or you thought of something later, then feel free to reach out to us and we can direct that to the right person. But otherwise, we really wanted to thank everyone for joining us and for making this a great experience. And as Jordan said before, we hope that you got some value out of it, especially if you are considering entering into your own transaction. And thank you again to all of our panelists for the excellent advice and sharing their experiences.
Thank you.
Thanks,
Appreciate it.
everybody. Thanks a lot, guys.
Take care.
Thank you.
Thank you.